Welcome to How to Shatter Industry Underwriting Performance with Predictive Analytics web seminar hosted by Valen Analytics. I'm Kirsten Marr, Chief Marketing Officer for Vallon. We will begin with introductions from each of our featured speakers. Karlyn, please introduce yourself.
Hi, I'm Karlyn Carnahan. I'm a research director at Celent, which is an analyst firm focusing on research and consulting in the insurance space. We cover technology issues and emerging trends in the insurance industry.
Thank you. Matt, please introduce yourself.
Good afternoon. My name is Matt Whisenant, Vice President of Insurance Services and Director of Underwriting at FHM Insurance Company, a monoline workers' compensation carrier operating in the Southeast. I am an underwriter by trade. I've held multiple progressive underwriting roles over the course of my career. Began in monoline comp, but I've also underwritten multiple lines of insurance, both commercial property and casualty for regional and national carriers. Participated in the rollout of predictive modeling twice prior to joining FHM, and looking forward to sharing a little today on why FHM has positioned analytics as a cornerstone of our strategic plan and how we went about integrating it into our underwriting process.
Thank you, Matt. Bret, please introduce yourself.
Thank you. I'm Bret Shroyer, a VP of Services here at Valen Analytics. I'm a property casualty actuary, fellow of the Society, have been for about 25 years now in the industry, most of that time in primary insurance, in rating and reserving. Most recently, 5 years at Willis Re in reinsurance, where I did pricing and reinsurance placement, but also led their predictive modeling practice. And now 2 years at Vallon, where now at Vallon I help companies with on the implementation side, actually putting the predictive analytics, the data, the models in place, integrating that with their systems and their business rules, doing underwriting training, and helping companies get bottom line value from the implementation of predictive analytics.
Great, thank you, Bret. We will now begin with a presentation from Karlyn Carnahan of Celent. Karlyn, please take it away.
Thanks, Kirsten. I want to start by talking about why we're even talking about predictive analytics. There are a lot of different things occurring in the insurance industry that are driving a tremendous interest in this topic. I'm going to start with the economic issues. I mean, those of you who are carriers, you're feeling this, right? Combined ratios are ticking up. And AM Best reported just recently that they believe that the industry is sort of done taking the reserve releases that may be redundant, which means that we're starting to, hit the bottom of the bank. So combined ratios up. The rates continue to see downward pressure. It is an extremely competitive market down there. And unfortunately, you're getting less revenue for the same risk. You're not making it up on investment income. Unfortunately, the market is not, rewarding holding on to money. And so what are you going to do? You have to find a way of operating more efficiently, and you have to get smarter at underwriting. You have to be better at choosing risks and pricing risks. Go ahead, Kirsten. One of the things that is driving this tremendous revolution of the underwriting process is this explosion, almost a tsunami of data. We have all of the old data that we always had available to us is available electronically. Right? We can order an MVR, by pushing a button. The data is instantly available. We don't have to wait for paper documents. So this old data is moving faster and is more accessible. New data, growing exponentially. Just a couple of examples here. The Internet of Things with telematics data, social media data, data from new combinations of insights. You can get scores that will predict the likelihood of sewer backup. So lots of new data that we've never had before. And the internal data is much more readily available, whether it's the underwriting data from the policy side, the claims data, customer behavior data. More and more carriers have found ways of accessing this data so that it's available. And the tsunami of data that we have available is really creating tremendous opportunities to transform the world of underwriting. Next slide. So we survey carriers and say, so what are you doing for the coming year? This is the data from 2016. We'll be updating this report in another month. We'll be sending out some surveys. But what we find is that this is one of the hottest topics out there. 7-8% say that they're planning to start an analytics initiative. 20% say that they're planning it. More than half, almost 60% of the carriers say they are in the middle. They are underway and continuing an analytics initiative. So tremendous activity. And as you see, there's nobody who says that this is not under consideration. There's nobody who says analytics doesn't matter. And so why is this? Generally, what carriers are doing when they're moving down the analytics path, they are trying to improve the decision making. They're looking for ways of creating unique insights, finding new sources of data that will help them with that magic mojo, the underwriting piece. They're certainly looking to improve the overall management and the planning. If you can get a better handle on the characteristics that drive a good book of business, then you can do a better job managing your agents and planning the results. And if you can focus on driving in those accounts that you want to work on, then you spend less time working on accounts that you will inevitably decline. Analytics are being used to improve the processes to help people get smarter. And it's being used to decrease regulatory fines, because the more that you can systematize the underwriting process, the easier it is to demonstrate that you are being fair, that you are not discriminating. Next slide. So lots of great reasons to focus on analytics, but there's a lot of challenges that carriers have. And this is a survey we did of carriers saying, so what is your problem? And what you see here is that the biggest problem that carriers have when it comes to data is getting an analysis quickly. It's very hard for carriers to pull data together and to very quickly analyze it or use it to analyze an individual account. They feel that the capabilities that they have today, the tools they have today, are just too slow. They also say that a huge problem is their data is very fragmented, so it's difficult for them to pull it together, and the data is of poor quality. And this particularly impacts smaller carriers who may not have the same richness or robustness of data as very large carriers. And yet very large carriers also report the very same issues, as their data is in multiple data warehouses sitting in the different applications. Interestingly enough, almost 40% say that one of the biggest challenges they have with data is culture. The industry is in a time of shifting culture from a more traditional underwriting process to a data-driven underwriting process. And that's hard. It's not just hard for the underwriters who are using data on a transactional basis, but it's also a challenge for product managers. The role of the product manager is changing dramatically, and when you have folks who have been in the job their entire career, finding new ways of looking at the book can be challenging to folks. So lots of different areas that people have. One thing that you'll see is very few people say that the problem is too much data. Not really seeing that as a huge issue. It's really around how do I use my data to very quickly analyze it so that I can use that in a transaction. Next slide. So if you're an organization that is thinking about going down the path of becoming data-driven and using analytics and using predictive analytics, there are kind of 4 chunks of work that you have to focus on. The first chunk of work is around the data itself, right? Do you have enough data to be predictive? Is your data clean? Can you link your existing internal data sets? Can you remove redundancies easy? Can you find the appropriate third-party data? Do you have the right tools that allow you to do reporting and to do analysis, right? Is it a data warehouse, an ETL? And there's a lot of problems. Some folks feel like I have to get this part in order before I can move on. I will tell you that's not necessarily true. It's good to get your data house in order, but that is one of those ongoing lifetime projects, sort of like maintaining your home. But the next set of problems is the use cases. What the heck should I predict? And a lot of people are in the process of trying to understand all of the possibilities for predictive modeling. So the first thing you have to think about is, what is the right use case? Am I going to be looking at predictive analysis to try and drive risk assessment and pricing, which is one of the most common usages and tends to have a huge bang for the buck? Or am I going to look at analytics when it comes to new business acquisition or claims? On the claims side, it's typically around predicting which claim is going to go wonky fast. Am I going to use it to try and reduce expenses by, for example, only ordering third-party data that is likely to have data in it? I hate paying $12 for an empty MBR. or service automation, optimization, which customers will benefit from a physical premium audit or from a physical loss control. So there's a lot of different use cases, but once you have figured out where you want to go, the next question is, how am I going to create the model? Most mid-sized and small carriers, frankly, can't support the expense of a full-time data scientist and a team. Larger carriers often will have data scientists, but smaller carriers don't. And so you have options. You can hire somebody, an outside firm, to create a specific model for you, custom-made based on your data. You can try and use third-party scores. You can work with somebody like Valen with a contributory database who can patch the holes in your data and augment it and create a custom model for you. So there are a lot of different options that you have to think about in terms of how am I going to get there. Once I have my use cases, now the question is, how do I operationalize it? When these conditions exist, you should behave like that. So how do I get my underwriters and my adjusters to do it? A lot of folks are lucky enough to have replaced their core systems and have solutions that will work with business rules and workflow and can automate it that way. But as I mentioned, there are also cultural changes, and there are changes in how the product management happens. You're now managing the rules and governing the rules. And lastly, the fourth chunk of work is governance. Is the data still clean? Are the rules working the way that you anticipated them to? Do you need to tweak any of that at all? Have the models been implemented consistently and appropriately? Next slide. So what we advise is that if you're looking at making good decisions, start by working back from your big picture. What is the big impact that you're trying to make, right? I'm trying to improve my underwriting. So if that's the big impact, work backwards. What's the big action? What decisions do you need to make that have the potential to lead to that impact? And then move back from that. What insights will you need in order to make those decisions? And lastly, think about what data and tools are required to drive those insights. Often we try and do it the reverse. We say, what data do we have? What tools do we have? And let's drive from there. You're much better off trying to take it backwards from the big impact. Next page. So the typical use cases in underwriting tend to revolve around risk quality, assessing the quality of the risk, and then aligning the pricing to that risk quality. Around data, loss control, and premium audit. Should we send out a physical audit? Should we do a full service plan? On the claim side, again, it's around predicting complexity. Is it likely to have an extended return to work? Or days off work? Is it likely to result in high medical claims? Is it likely to have fraud? And on the marketing side, we're starting to see quite a lot of work going on in terms of predicting defection and, in fact, the different sources or reasons for defection in order to intervene effectively or to handle cross-sell options. Next slide. So when you take a look at predictive analytics, it does seem to be providing a competitive advantage. And when we look at what's happening in the industry, we've asked the carriers, where are you using predictive analytics? And what you see is that about half of the carriers say that they are currently using some level of predictive analytics for at least one line, and another 40% are planning. Only 13% of folks say that this is not something we're going to use in the underwriting. The numbers aren't quite as strong in marketing or claims, although as you can see, there are major plans happening. And so as you look across underwriting, marketing, and claims, the reality is that the bulk of the industry is either currently using predictive analytics in their business or is planning to use predictive analytics in their business. So if you're not, if you're the ones who are not using data to help drive those decisions, you are placed at a competitive disadvantage. Next slide. So as you think about how to roll out analytics to get some sustained impact, we suggest a pathway of first thinking about those impactful use cases. So what are the key value levers that you're trying to drive, and working backwards from those decisions to the data that will drive the impact. We recommend that you develop tools that are easy to use, easy to visualize, to make life easy. If it's hard, people won't do it. So using tools where you can visualize the results of the predictive analytics and very easily consume the output makes it much easier to drive that culture. Engage the business users, because a change is hard, and especially when change is imposed upon you. It's always fun to change when you're the one in charge of it. It's always hard when it's happening to you. So make sure that they understand the tools are available, make sure that you have thought through the process of how they're using these predictive models and whether they're intervening and overriding where appropriate or not. Create a flexible platform. Find ways of scaling these capabilities so it's not all one-off. Again, it has to be fast and easy. You have to make this industrialized. And lastly, we recommend that as you move down this path that you bring in a team, you create a team that is a combination of both business skills and technology experts, or the technical expertise, the analytical capabilities. There are a number of folks who are great at analytics but don't understand the business. There are folks who are great at the business but may not be the best at analytics. When you can combine those, that's when you get the best insights. Next slide, I would say, last thing is lessons learned. We've seen a lot of carriers go down this path, and some of the things that we have found that are particularly important. Strong support among your senior leadership. You have undertaken a long journey, and there is a huge cultural change. And so having the leadership say, this is important, this is critical, and setting expectations on the timelines is one of the key factors of success. Start with the easy problems, right? So that do simple problems so that you have success stories. Work with an appropriate part of the organization, implement them easily, make sure to tell these stories to the people who are working. We do recommend investing in building a robust data mart. It's much better to have a single version of the truth. And, you know, it is hard work. Data, unfortunately, is not the easiest part of our business. And we would recommend that you don't compromise the upfront effort required to create a really nice, clean data source. Many people have begun thinking about establishing an analytics center of excellence to focus on those 4 chunks of problems that I talked about. And lastly, the change management. You can't forget the cultural impact on both the underwriters and the product managers. So don't think of that as the last step. Consider the cultural aspects as you're going down the pathway. And with that, Kirsten, I'll turn it back to you.
Thank you, Karlyn. Most appreciated. We will now hear from Matt Whisenant of FHM Insurance. Matt, take it away.
Thanks, Kirsten. As a current client and partner with Valen Analytics, I'm pleased to share the FHM story as it pertains to our migration to a data-driven organization, leveraging predictive modeling to produce consistent outcomes and improve results, and we greatly appreciate Valen's expertise and assistance in making this transition. I just wanted to say that first. Today, I'd like to set the stage by telling you a little about FHM. FHM is one of the oldest monoline work comp carriers in the Southeast. Began operations back in 1954 as a self-insured fund, started by the Florida Hotel Motel Association to provide a workers' compensation solution for their members. And by 1997, FHM converted to a mutual insurance company, began building policyholder surplus, and by 2014 we had celebrated our 60th anniversary in operation. Today we're actively writing in Florida, Georgia, South Carolina, North Carolina, Virginia, pretty much southeast, also filed and licensed in Alabama and Kentucky. Our operations are headquartered in Orlando, Florida, with a corporate office in Jacksonville, Florida, have about $30 million in written premium and are currently rated B++ by AM Best. Now on to the case study. So in order to begin our case study, I think we have to kind of jump into our DeLorean and travel back in time to around late 2005 when the company first obtained a B++ rating from AM Best, having previously been non-rated up until that time. One of the many takeaways from the first several reviews with the analysts at the rating organization was that being monoline and monostate was an impediment to attaining further upgrades. The analysts felt that diversifying into other states would alleviate some of the concerns associated with the company being beholden to legal, regulatory, and overall market conditions associated with only one marketplace. Sounds pretty reasonable. And around 2007, the company embarked upon an aggressive expansion and growth plan. Now, not like other stories, unlike other stories of rapid expansion and growth that likely we've all read about, FHM experienced significant pains associated with moving into those new and unfamiliar territories. Pains that weren't immediately recognized but became a substantial burden once they began to manifest themselves. So it really leads us to, I guess, the business problem. So with those good intentions, began moving into other southeastern states. Georgia first in 2008, followed shortly thereafter by South Carolina and North Carolina in each of the subsequent years. These were all open rating or competitive rating stakes with filed loss cost multipliers and schedule rating plans, and they were, I'll say, newer pricing, new concepts for a Florida-based carrier. So for those on the line, keeping in mind, Florida was and remains an administered or controlled pricing state, meaning rates, not just loss costs, are submitted by NCCI on behalf of the industry to the Office of Insurance Regulation. So outside of consent to rate, everyone pretty much has to use the same rates and from a pricing standpoint differentiate themselves with either a dividend plan or products as a retrospective rating plan, etc. So by late 2010, an upgrade to A- opened up additional opportunities, such as in contracting and other classes that we weren't quite as familiar with given a history of underwriting mostly hospitality and service-oriented business. The company had grown on average about 21% per year between 2010 and 2012, even in the midst of continued rate declines in the home state of Florida. So in the midst of all these changes, of course, was still the ripple effects from the 2008 economic collapse. This, when combined with lack of experience in these new jurisdictions, new and unfamiliar classes of business, some inadequate filed rate positions in growth states, flawed approach to pricing at the time that kind of exacerbated the rate level troubles and promoted pricing inconsistency, and generally poor risk selection in part given the absence of strong tools to aid in the selection process. This all culminated in a rating downgrade in 2012 after posting about a 140 combined, only 2 years after attaining that A- rating. I'm not sure this story is particularly unique. As I said, many carriers experience difficulties in moving into new markets, states, and products, but add some of the economic turbulence, and this was quite a storm for a relatively boutique work comp carrier. So now that I've kind of lifted everyone's spirits with that story, I'm going to take us back to the future, leaping forward 3 years to what I'll call the last few pages in a book still being written, to tell you that we recently posted a 104 combined in 2015, effectively breaking even on an operating ratio basis, and in the first 6 months of this year we've been in a position to put about $500,000 into surplus. So we're on our way, still have lots of work to do, but on our way. So fortunately, despite all the challenges FHM has faced, we remain highly capitalized with a balance sheet in of itself worthy of an A rating, noting that the premium to surplus is a healthy 0.78 to 1 today. So the question is, how did we get from 2012 results to the results we're starting to see in 2015 and 16, and how are we going to continue to make the necessary additional improvements? Well, analytics is certainly playing a role, so let's kind of proceed to talk about the business response to the problem. So clearly, it was operating performance that precipitated the downgrade, and it was going to be operating performance that will earn the rating back. So in late 2013, we began a turnaround plan that had analytics at the center. After having the benefit of some previous experience with predictive modeling, both myself and FHM's new CEO had pretty good idea how to go about implementing analytics. With the management commitment that Karlyn mentioned earlier and assistance from partners such as Valen, we knew we could turn the vision into reality. Of course, we needed to do underwriting guidelines, and rate filings were also implemented to better position FHM to take full advantage of this new data-driven approach. So when it came to the analytics, there was 5 key elements, 5 key things we found we needed to be successful. And I can't say these in any particular order, but they certainly all needed to be covered. So the first I have here is we needed to secure additional data. We needed new data, especially for growth markets where we didn't have the historical presence, expertise, and market knowledge. We needed to combine our limited data set with the likes of Vallon's consortium to help us fill in the gaps and better understand the risks. We also needed to couple this new data with expertise and market intel from field underwriters and claims adjusters that had years of experience in these marketplaces. So I'll stop there just to reinforce that last part. Market intel and expertise from personnel. This remains a people business. In my opinion, it's a relationship business. The model is a tool to help guide risk assessment and decision-making process, but is not an outright replacement for it. the best outcomes seem to come forward when underwriters are leading the process, yet incorporating the model into their assessment. Number two, we needed more consistency and sophistication in our pricing approach and risk selection. We knew predictive analytics could help us accomplish those objectives. We decided that analytics was going to help us create a point from which to begin the process, underline begin. As it pertains to pricing, we worked with Valen to devise a means for converting the model-indicated risk score into a pricing indication that was relative to each state and then shaped underwriting authority around it. That way, underwriters could still leverage their knowledge of the account, the circumstances surrounding the submission, the agency relationship, etc., and yet appropriate collaboration points were set up when we started to get a little too far away from the model indication. Basically, it was a point where we said, let's put our heads together and discuss why the model is scoring this way, what information do we have to pair with the model results that leads us to want to go perhaps in a different direction. And now, hold on to that for a thought for a moment, because we're going to talk about model constraints a little later. But back to pricing. For accounts under 100,000, the model seems to provide a solid data-driven starting point for pricing. It's particularly helpful as many other what I call traditional methods for approaching pricing on small business are either to attempt to derive some type of simple loss pick, which does not seem to work well, or it's mostly left to judgment with the only data element other than experienced model loss run being what the agent's target price is. So we like to think this provides a little more educated starting point in formulating the approach for these accounts. For accounts over 100,000, and again, these are, I won't say arbitrary numbers, it's just our philosophy. It could differ by company, but for us, for accounts over 100,000, while there remains authority parameters around the overall model score, bin score, because we do want to have some of the higher bin scores, 9s and 10s, etc., elevated to a supervisor, the model pricing indication in and of itself becomes somewhat advisory, and we kind of begin to transition to a more actuarial approach to developing losses, driving a loss pick, applying that pick against prospective premium and expenses to formulate some type of indicated combined ratio, and then shaping authority around that. So basically, we find the model struggles a bit more with the larger, complex accounts that have multiple locations and broader scope of operations. Leveraging the model with traditional tools, again with the underwriter, we believe provides better aid and the best decision tends to come forward. Now, the other piece of this from pricing is the risk selection. So a sophisticated modeling tool cannot aid not pricing but developing underwriting questions and ensuring proper risk classification. So a lot of time is spent about talking about modeling from really just a pricing tool standpoint, but often is neglected some of the supporting tools that could be derived from the data. So Valen's Shroyer tool, for instance, includes an invaluable misclassification and resulting premium impact score component to it. And we found this to be tremendously helpful in this area as it compares the class codes and payrolls presented on the application to audited risks for similar risks. So I'll digress for a moment to briefly explain. So for example, it helps identify when the payroll allocation amongst the class codes appears atypical when compared against the average allocation observed on audit. So let's say the governing code is 8380 for automobile service repair. Let's say, according to the model, upon audit we find that 8810 clerical, which we all know is one of the most abused classes, usually only constitutes about 15% of total payroll. However, the risk presented to us is showing about 45% of total payroll allocated in 8810. This is going to prompt the underwriter to ask questions about the nature and scope of duties performed by those shown in Class 8810 on the application. Perhaps we come to find out that the service writers were improperly assigned to 8810 instead of 8380. In another example, it helps identify what percentage of time upon audit 8380 remains the governing code, and when it doesn't, what class code becomes the governing code, or what companion codes tend to be shown at audit when 8380 is the governing code. So in looking at these governing class swaps and these companion classes, it aids underwriters in formulating questions about the operation up front, better understanding gaining a better understanding of the risk, improving selection, and increasing the likelihood the risk is classified properly from the outset. Number 3, we need to develop a strategy for how analytics was going to work in our organization. Many questions needed to be answered in this area. How is the model going to affect authority, the workflow, our interactions with our agency force? What impact was the model going to have on how we approach new and renewal business? And I've spoken to a few of these already in one form or another. I can tell you that the renewal business in particular will present perhaps the greatest challenge. Trying to run the renewal book through the model the first year will be very difficult, and from experience I would recommend being reasonable in how you approach this. Don't try and attempt to conform everything to the model indications, which closely aligns to what I previously said about don't follow the model blindly. Generally, risks that score poorly will have plenty of other factors to cite and justify to an insured or an agent, materially changing your pricing approach or disposition on a renewal. It's the ones that kind of score in the middle and have generally good experience, yet are currently priced very aggressively, that will get the most attention and draw the most ire from your agents if pricing changes are made. Now, there's no good need to go run off good business. For FHM, we find that the ones that meant the most to us, meaning where the model and the underwriter agree that changes should be made, we would proactively work with our agency force to determine how many of these risks we might be able to make some material progress on this year, and which ones we can agree to perhaps take a more modest approach and wait and reevaluate next year. Don't try and do everything at once all in one year. You'll get a lot of disruption from that strategy, unnecessary disruption, and your agents are going to appreciate being part of the conversation. Which brings us to the next question on how would we message regarding the use of the model. For FHM, as I said before, it's just one tool. I wouldn't cite the model in and of itself as a reason for doing or not doing anything. Again, if the scores are intuitive, there are usually other identifiable contributing factors that can be cited for why one might decline a risk or be reluctant to price the risk more competitively, and I would tend to focus on that. So as you can see, considerable time and thought needs to be put into how it aligns with the broader strategic plan. It's likely to differ substantially between organizations. You just have to figure out what's the right approach for your company. And I did find that your modeling vendor should be able to help make some suggestions in this area. For FHM, we found that Valen truly understood our business, had people on staff such as Matt Frazier, the VP of Applied Analytics, who's actually done the job of an underwriter and led an underwriting team. This was immensely helpful in developing a list of all the considerations we needed to take into account in order to move forward in confidence. Number 4, once we selected an integration approach, we needed to devise a solution that made it easy to incorporate within the underwriting workflow. Underwriters not only need to understand how to interpret the scores, we needed to integrate the analytics in a clear and concise manner into the workflow process. So for our organization, we worked with Vallon and our IT vendors to seamlessly integrate the analytics so the scoring and report generation was part of an intuitive, fluid process when it came to underwriting a file. In short, to the extent possible, make it easy so they're not having to go out here, there, and yonder just to pull all the different elements together they need to and tools they need to price a risk and determine their underwriting authority. Maximize the benefit while minimizing the disruption to the workflow. No need to create unnecessary and inefficient bottlenecks in the process. Number 5 was a critical item, and I'll spend a little bit of time on this one. We needed underwriters on board and to understand how combining analytics with their expertise could deliver the improved results we desired. For us, we first focused on the kinds of things that are going into the model and really looking at how to interpret the scores and those top risk factors the model cited when producing a score. Basically, answering the question, what kinds of things does the model know, so as to ascertain why it's responding in a certain way, and then what things does the model not know. For example, one risk factor may be regional loss history. A risk may present a negative indicator associated with this factor. Now, recall work comp rates apply statewide, same rate same risk whether you're in South Florida, Central Florida, or North Florida. So one of the questions we posed to our underwriters was to think about this. How many underwriters in your organization would have solid insights into the differences in the cost of adjudicating the same claim between one area of the state versus another? And if they did, how would they independently know how to go about calculating that difference and weighing it into their pricing approach or thought process? Just talk to your claims professionals about the different challenges they experience within a state when it comes to access to medical care from one region to another. Perhaps the hospital is the only game in town in some places. Certain types of specialists are few and far between and thus won't accept the fee schedule and demand 100% of their fees. Or the prevalence of litigation and the differences there between one area of the state and another. Those are all material cost drivers, not something we think about or have any kind of data to support and bring to bear in the underwriting process every day, but can certainly help us in attempting to contemplate this in a more educated and scientific way. And that's just one of the many multivariate items that in the absence of strong modeling analytics tools either just not being contemplated or perhaps equally as detrimental, built on some tacit assumptions that are being applied in an inconsistent and inappropriate way. Second, we focused on what the model doesn't know that the underwriters can bring to bear. This also served to reinforce and assure underwriters of the continued need for their expertise in deciding the ultimate course of action. The model only knows what's been put into it. For FHM, at the individual risk level, it knows the zip code, the experience mod, the proposed class codes and payrolls, the claim counts for the last 3 years. It doesn't know that the risk tripled in size during the same 3-year period, and now the frequency relativity is way off, as the new higher exposure basis being used is not representative of the terrible claim frequency when the risk was a third of the size just a couple of years ago. So once underwriters understand these things and what the model knows, what the constraints are, and how the model can help them develop a good starting point for approaching a risk, the adoption, at least for FHM, went well. Now, by the way, I mentioned constraints, and that's picking up on that thought I told you to hold on to earlier. This gets into a hot topic when it comes to rating advisory organizations. You're going to need to be able to clearly articulate how you're using analytics and at the same time avoiding model risk. In the example I just shared, the model likely rendered a more favorable score than it otherwise would because the historical claim frequency looked better against the newer higher payrolls. The big key is not to follow it blindly and perform regular routine monitoring of underwriting files and model performance. Underwriter acceptance. We're going to kind of continue on this theme a bit. I wanted to spend a little more time toward the end here on acceptance, as this tends to be a significant barrier and can certainly affect the organization's ability to succeed in becoming data-driven with predictive modeling. Earlier, I referenced previous exposure to predictive modeling. Prior to joining FHM, I had encountered analytics in previous lives. They were great learning experiences with great companies, but as they were early adopters, they struggled with implementation when it came to their first runs with predictive analytics. They endured significant business interruption, alienated a number of agents, which in turn meant they lost good business and were presented with fewer new business opportunities, and lost a number of good underwriters in the process. Recall that Karlyn used the words data-driven in her presentation, not data-dictated. In one case, the model indicated price, or the no-haggle price, as I put it at the time, actually dictated the price and no underwriter or even supervisory discretion was extended. Thus entered the model risk I previously mentioned, not to mention the underwriter and agency force frustration and the business interruption. In another, traditional underwriting was openly referred to as tribal wisdom when first introducing the concept to underwriters. And even though in retrospect I think I understand the point that was trying to be made, it didn't go over too well with most of the underwriting staff. So I'll just underscore once again, in my opinion, that this is a tool used to augment the underwriting process and help underwriters make better decisions by giving them data-driven insights and a place to begin, not in their evaluation. And again, at FHM, we've shaped authority around the model so underwriters can still operate with the appropriate amount of autonomy, yet collaboration is still prompted when we get a little too far away from that. Now, many of the same traditional authority parameters such as experience mod, premium level, classes of business still apply. On certain submissions, adding the model score now into the mix effectively reduced the authority the underwriter may have previously enjoyed on that same risk and made them have to put together a concise referral. However, on others, it actually liberalized the authority as we were more comfortable extending some additional authority on those risks that scored well in the model. So once underwriters understand the insight the analytics can provide and they can harness it, make better decisions with increased confidence. That's going to challenge their tacit assumptions that have been building over the years in a good way. You're going to get your folks to really think and hopefully, as it did for us, generate a number of good examples for conversation and discussions in your meetings when those situations occurred. I had a senior underwriter that has been burned once on a plumbing risk years ago, and even though the company strategy and agent-facing appetite guide includes writing plumbers, they take the position that I don't really like them, so I'll be super conservative by either finding reasons to decline them or even on perceived good ones, I'll just price them high. Now, aside from the marketing impacts, one has to wonder about the quality of those you do manage to write somehow under that strategy. The model and a solid understanding thereof may help that underwriter gain a higher level of comfort in proceeding with an appropriate pricing approach for a risk that is acceptable in accordance with the guidelines. So bottom line on underwriter acceptance, it starts with committed management. I've said it a couple times, I know Karlyn did. Management must have attained the necessary level of comfort with how the model works and how they want it to play into the decision-making process. Must know and recognize what its limitations and constraints are and be in a position to clearly articulate to the underwriters these constraints and how the underwriters should interpret and apply the scores, how they can bring their knowledge and expertise to bear to render the best decision. Then on to some implementation considerations. Some of these are themes that recap some of the previous slides, but I thought they're valuable nonetheless. Transparency, context, and predictive scores, openly sharing with your underwriters how implementation of the model will help in achieving the company's strategic objectives, demonstrate how the model works, they understand how it fits in the process and what they can bring to bear to get that best decision brought forth. Having a detailed training plan with workshop sessions, gather the underwriters, go through live examples, but from the very beginning, ideally even in the pilot or test phase, go through live examples and have them bring them to the group so you can review and discuss the model outputs. Focus in particular on those examples in which the underwriter feels they're having difficulty understanding the score. I would recommend doing the exercise routinely and, quite frankly, don't stop. I encourage it to continue. Use quality assurance reviews to make sure the uptake is good. In other words, monitor the program and what individual underwriters are doing with the information. Clear decision and supervisor review guidelines. So deciding how the model affects prescribed line authority and how it affects, it guides the pricing approach. When the risk needs to be referred for collaboration, what point does that happen? Equipping supervisors with tools they need to support underwriters in incorporating analytics and how when to elevate concerns regarding model outputs and potential effects on business, particularly in the beginning. Technology, get it integrated into the workflow, as I previously described. For FHM, it's seamless behind the scenes to not cause any disruption or bottlenecks to the underwriting workflow to the extent possible. Try and do this. At the very end, we have a results slide. The initial results are promising, as you can see from the chart, which speaks to some of the troublesome growth states that we were in. Some of the initial re-underwriting and increased rates had some benefit in policy year 13, but the real progress can be seen at the beginning of policy year 14, where analytics were first fully integrated into the process. The results are preliminary, but I can tell you we definitely see an impact on the losses sustained. the severity thereof, and frequency. Our frequency as a company is at a historic low. Frequency per million of earned payroll dropped almost 18% over the last 2 years. So I'll leave you with this. As Al Pacino, one of my favorite actors in the movie Any Given Sunday, says, "This is a game of inches. Work comp is not a high margin line." And as Karlyn said earlier, combined ratios are ticking up, investment income is a growing challenge, and rates are seeing downward pressure. For FHM, we're leveraging analytics to achieve outcomes that on the whole are better, more consistent, delivering better, more consistent underwriting decisions and improved pricing precision. In turn, we're hoping to squeeze out a few more points, or in this case, inch ratio, and perhaps pass a few of those points along to a few unsuspecting competitors. With that, I thank each of you for your time. Certainly open to answer any questions upon conclusion of the presentation. Kirsten?
Thank you so much, Matt. That was a very, it was really specific, and it incorporated a lot of the best practices that, you know, I think we at Valen see that translate into some of the successes you were just talking about, so thank you. Okay, now we will turn it over to Bret Shroyer of Vallon. Bret.
All right, thank you, Kirsten, and thanks, Matt. You give me a lot to speak on here, and some of the things that I have to say are actually going to dovetail nicely with, you know, with where you're coming from. At Valen, you probably know this, we're passionate about helping people make great decisions aided by real-time data, and our data-first strategy is unique amongst analytics providers. Has enabled us to solve some really tough problems for the P&C industry, help clients in lines of business with historically poor performance. Being at the front lines of data and advanced analytics in P&C is really an exciting place to be right now. Every year, we survey the market, and we're specifically studying the use of analytics and underwriting because this is where most of the momentum is. Every year, we conduct the survey, and this year we can report that a lot has changed from last year. The number of insurers that are using predictive analytics and underwriting has increased 9 points over the last year, rising to 65% just the last 12 months. To reiterate something that Karlyn had said earlier today, when carriers have historically complained that analytics takes too long, we believe that one of the influencing factors here driving adoption up is the increasing availability of some easy-to-use, easy-to-implement models and access to real-time analytics tools. It's no longer takes too long. We're putting it into real time, and we're speeding up the time to market and the time to deployment, and that's having a big impact in the market. We also asked the participants to give their top 3 reasons for moving to predictive analytics, as you see here at the bottom. The top 2 are better risk assessment, more accurate pricing. Those are pretty intuitive. The third one there, avoiding adverse selection, that's a surprising one. Carriers are recognizing that detecting adverse selection is one of their biggest challenges that they face, and it requires access to predictive analytics to perform. You just can't use adverse selection as an offensive tool, as Matt just said, without access to predictive analytics to see where the good risks are and where the bad risks are. Last year, we also talked about the art versus science debate in insurance and where carriers are seeing friction. One of those areas we asked about was around price, in particular a real or perceived notion that actuaries and underwriters are at odds in some way over price. This year, only 25% of carriers reported that they're seeing any concern about adopting predictive analytics. It's half of where it was a year ago. I think Karlyn said that there were no insurers that said that they had 0 reservations. Everyone was somewhere on the spectrum. The issue isn't gone altogether, though, because all the carriers aren't currently adopting, but it's no longer an overshadowing concern. Carriers are getting more comfortable, and there's momentum at the executive level. It's definitely moving in the right direction. Also significant is the decrease in the underwriter actuary pricing conflict number. This year, 52% of the respondents confirmed that they were experiencing or seeing this internal price conflict. This is down last year, but again, the issue isn't completely gone. We like to see where this is going. We can't wait to see where these stats emerge the next time we perform the study. In truth, though, there's really no good reason for this friction about price, because it's not a question of replacing the underwriter with a model. It's about enhancing the underwriter's ability to make the decisions. On this slide, you're looking at a lift chart. This is the standard chart for looking at the predictive power of a predictive model. The lift itself is indicated by the red, blue, and green lines. A lift chart attempts to show the strength of a predictive model by showing how well a model prediction, that's a scale of 1 to 10 from left to right here, how well that prediction translates into actual results, which is shown as a loss ratio here in the vertical axis. So for example, let's look at the blue line. This is, or I'm sorry, the green line in this case, is a group of underwriters, and they had predicted what the risk quality was for a group of risks, and given each one of those risks a score of 1 to 10. We then look at what the loss ratio was for everything that the underwriters gave a score of a 1 to. And that loss ratio was below average. In this case, the loss ratios are all scaled to 1 being an average loss ratio. So the underwriters did predict well where the best loss ratio accounts would be, and 2 and 3 and so on. And in fact, all the things over on the other end of the scale, 8s, 9s, and 10s, those are the high loss ratio accounts. When we measured the differential between the tip and the tail, between 1 and 10, we see there's about 50 points of differential there. That's what's called lift. So in this case, we produced a lift chart on the underwriter's prediction of loss ratio, and there's 50 points of lift. We then looked at, on the same book of business, we looked at a predictive model and the model's recommendations. That's the red line here. And what we saw here is that the model also produced lift, and it produced a greater amount. It actually showed that the things in bin 1 that the model thought would be the best business had a loss ratio of about half what was this, half of average. And the stuff at the other end of the spectrum, which is bin 10, where the model said the worst business would be, is about 1.75 times average. The lift here is 125 points. Finally, we combined the underwriter opinion and the model score. We simply took an average of the two scores. So if the model gave it a 1 and the underwriter gave it a 3, the combined score would be a 2. We plot all of those new scores now on the blue line. What we saw here was kind of surprising. The combined model, or the blended model, gave us the best overall lift. There's a clear indication that the underwriter and the model are looking at some different information. Under this sort of combined score, a risk can only stay a bin 1 if the model and the underwriter both agree that it's a great risk. Recall what Matt said earlier about what the model knows and what the model doesn't know. The strength of the combined score here is a confirmation that there's a significant benefit from integrating predictive analytics into underwriting, not replacing the underwriter with the model. We like to bring this exhibit in and show this to underwriters during training and adoption to let them know we're not interested in replacing what they know. We're just looking to have them integrate some of these predictive analytics scores into their process, because it's going to make the whole process better without replacing what it is that they do. All of the data, analytics, and technology is only going to get you part of the way. If you don't focus on what people are actually going to do with the insights that you're providing to them via the model. Our clients spend a lot of time thinking through this process holistically. We introduced the notion of applied analytics to start with the end in mind and ensure our clients will actually realize the benefits that analytics can offer. This whole process runs kind of parallel to the pathway of 5 elements required to achieve sustained analytical impact that Karlyn mentioned earlier. First, we're going to make sure we're solving a business problem that is actually important at the corporate level and is tied to the strategic goals. We're going to create some powerful analytics here. Second, we're going to make sure that the analytics that we're building are seamlessly integrated into the user's workflow and their interface. We're going to develop user-facing tools and reports. Third, we're going to make sure that context and transparency into what the model is doing and saying are present, so that the underwriter understands what's driving the analytics results. We're going to engage the users in the analytics platform. And 4, we're going to bring the underwriters the proper training on how to leverage the analytics into their own decision-making in combination with their expertise. We're going to bring in subject matter experts in systems, in data, and in underwriting to make sure the analytics are embedded into the client's process and their understanding. This is getting the underwriters and the business partners at the client side involved in the implementation and moving beyond the model. The results for these types of insurers, we're taking an applied analytics approach, combining technology with human expertise are undeniable. We did a broad study of workers' compensation clients who have been using predictive models in pricing and risk selection for at least 2 years. This represents a really diverse set of firms with work comp line of business premiums ranging from $15 million to $350 million annually. Companies like Mass FHM are certainly represented here in that size spectrum. We went out to SNL and we pulled workers' compensation statistics for our study group, that is carriers using predictive analytics for 2 years or more, as well as those same stats for the workers' compensation industry as a whole. What we found was that as a group, the study group saw a 30-point improvement in your loss ratio over the 5 years. At the same time, the industry saw a 15-point loss ratio improvement. So it was a great period for the industry as a whole. Loss ratios are going down. But carriers that were making the move into predictive analytics saw their loss ratios improve by twice that over the same period. This is a great result for carriers using predictive analytics. At the same time that these carriers were driving down loss ratio to predictive analytics, they were experiencing top-line growth. The same group of carriers saw year-over-year premium growth more than 3 times the industry average. Think about this for a second. This is really a story of delivering bottom-line value. These carriers have shown that with predictive analytics, you can grow significantly faster than the industry while generating significantly lower loss ratios. There's a common perception that there's a new business penalty in P&C insurance. In order to grow, you're undercut the incumbent carrier, which is going to result in increased loss ratios. There's also a perception that the easiest way to improve loss ratio quickly is to take up rates or to non-renew bad business. And both of these actions are counter to top-line premium growth. Carriers in the study showed that improving loss ratio doesn't come at the expense of top-line growth, and that top-line growth doesn't always bring a new business penalty. These carriers improve their loss ratio not by restricting their appetite or non-renewing a bunch of business, but by looking at individual risk quality and making the right risk selection decisions. They showed that with proper application of analytics, you can experience both.
Great. Thank you, Bret. Karlyn, I'm going to have you kind of recap the key takeaways. I'm aware that we are at time. For those of you that can stay on maybe another 5 minutes, we'll definitely answer questions. We have several coming in. If you want to type any questions you have into your question box after Karlyn's done with the key takeaways, we will certainly field questions for any of you that need to log off. These questions will be recorded and in the link that you'll get tomorrow. Karlyn?
Yeah, thanks, Chris. I mean, I think the message is very clear. The first message is around the expansion of importance, the number of carriers that are moving down this pathway, whether it's the study that we did at the end of 2015 or the study that you did this year. We continue to see this dramatic growth in importance, and it's becoming more important because these results are real, and they are hugely dramatic. When you can appropriately price a piece of business, not only do you get more margin on that business, not only can you grow the book, as was pointed out, but you're presenting a more consistent appetite to your agents, and so you get more business submitted because they're better aware of what it is you want. But successfully implementing this isn't just about plugging in the technology. There are some huge cultural issues that have to be thought about, whether it's involving the underwriter in understanding the models, whether it's shifting the role of product management, whether it's working to tune the models, whether it's explaining what you're doing to the agent. There are some real cultural issues that have to be dealt with to make this successful. That said, this is an area, hot topic, driving real results.
Thank you, Karlyn. I'm going to go ahead and start with questions. And this first question, I think, Matt, maybe you can start answering it, and then Bret or Karlyn, if you have anything to add. This question is, many underwriters hold on to long-term beliefs on what the drivers are of high and low loss ratios for their portfolios and programs. Will the process identify patterns in our data that will help us understand by a data-driven approach what the true drivers of high and low loss ratios actually are, and what if our data isn't granular enough?
Yeah, how much data do you have, I guess, is the first question. What's your sample size as far as credibility? As I said in the presentation for FHM, we, $30 million company, we didn't have enough credible data to act upon alone, and needed Valon's assistance to add the consortium to kind of fill in those data gaps. I mean, the model tool of itself will help in identifying those risks that will be predicted to perform over time better than your historical average, or worse than your historical average. But probably need a little more information in order to give you a better feel. Bret, what would you add to that?
Yeah, certainly, having access to the right data is important, and in predictive analytics, the hardest thing is getting the exposures and the losses lined up and having both sides. And the key to credibility in modeling is the number of losses that you have. You have to have tens of thousands of losses to build, credible models. The other part of the question was, is this going to show us, I think the question was kind of, is this going to show us the smoking gun? Where's the magic bullet we can go and we can write this and we can be profitable? Or what should we obviously not write because it's unprofitable? And that's rarely where predictive analytics points, because if something is that obvious, you'd already see it. You'd already know it. It'd be present in the base rates, or it'd be present in the class rates. This is rather pointing at things happening at the risk level, using real-time scoring, real-time decision-making, and knowing that plumber A and plumber B aren't really the same. There's something different between them, and knowing which one to accept.
Bret, I think this question is probably best for you to start answering, which is, what is the typical timeline between sort of the first analysis of existing data to when the new analytical approach can be used?
Well, this all depends. If this is an in-house effort by insurance companies, they're getting better at this as time goes by. If you'd asked that question a decade ago, that would be a 3-year timeline or something like that. And I think that a lot of carriers are now accomplishing this in a span of 12 months or 18 months. We take an abbreviated timeline. We have obviously a big data asset in-house that we use, and we're in the the 8-week to 12-week time frame from the first steps to analysis to the final deployment of a model.
Great. And then I think also a follow-up question: do we run into risk or industries that don't have a lot of predictive data, and how do you handle those risks?
Yeah, if it's industries that don't have, let's pick a line of business. If we have a line of business that doesn't have a lot of data, there's a couple of approaches there. One is to start getting carriers together to consolidate their data and pool up to build a credible model. Another is to link data in one line of business to another. Workers' compensation and BOP, for example, there's a synergy between the two. There's not a lot of good BOP data out there, but we found ways to integrate work comp and provide some relevant scores on the BOP side. So you have to be creative that way. And then third, there are industry data sources like the Census Bureau and Bureau of Labor Statistics and crime statistics and weather and so on. And so you can start to do things to start aggregating data across disparate locations that have similar characteristics, even though they're not geographically adjacent to one another, and you can start to build credibility that way.
Great, thank you. And then this last question we'll take today, Karlyn, maybe you can weigh in, and then Matt, if you have any perspective as well. How large does a carrier need to be for it to make sense for them to start hiring their own modeling resources?
Oh boy, that's really challenging. It really depends on where the carrier is trying to go. We often see the carriers in that, $2 billion range or higher with their data scientists. But here's the thing to think about. The question is, what are you trying to accomplish, and are you better off using your own resources, or can you get what you need from third parties? Carriers have limited amounts of headcount. And if you can get what you need from a third party and you don't have to invest in that skill set yourself, you can use that headcount for other things. If you can get someone else to build you a model, And then you can use that headcount to more effectively implement that model, whether it's with the underwriters or with the agents. It's hard to say that there's the optimal size, but there certainly is a trend in the industry for the larger carriers to be doing some of this themselves as they're applying the predictive analytics across other aspects of the insurance value chain into the claims and marketing area.
Great. Matt, just your experience working at carriers of different sizes, anything you would add to that, or is that kind of your understanding too?
Yeah, that's pretty consistent. Even with the super regional, you get into like a national carrier, whatnot, may have the resources to try and data sets to try and pull that off. But I agree with everything Karlyn just said.
Okay, great. And then it looks like we have one last-minute question in terms of the transportation business. Bret, maybe you can take this one. You know, what have you found to be the key drivers in terms of risk selection?
In terms of what kind of, regarding transportation?
Yes. Mm-hmm.
Oh, certainly, location, prior loss history, industry, and then the size of the exposure base are some of the keys. Looking at things like MVRs or DOT, if this is a commercial risk, looking at DOT records on safety inspections or violations are certainly very predictive, even if they haven't resulted in prior claims.
Great, thank you. Well, I think with that we will wrap it up. Thanks to everyone who was able to stay on the line and for attending today. Enjoy your day.